during such periods that my present investment philosophy took steadily more definite shape. It was then I decided there was not enough future in the type of in-and-out trading that I have described in the stock of California packing. During this period, I reached two other conclusions that were to be of some significance to my future business. Before the war, I had served all types of clients, large and small, with varying types of objectives. Most, but not all, of my business had been focused on finding unusual companies that would enjoy significant, above-average growth in future years. After the war, I would limit my clientele to a small group of large investors with the objective of concentrating solely on this single class of growth investment. For tax reasons, growth was more likely to benefit these clients. My other major conclusion was that the chemical industry would enjoy a period of major growth in the post-war years. Therefore, a high-priority project on returning to civilian life was to endeavor to find the most attractive of the larger chemical companies and make this a major holding for the funds I was handling. I by no means spent 100% of my time doing this, but in the first year after restarting my business I did spend a rather considerable amount of time in talking to anyone I could find who had real knowledge of this complex industry. Such people as distributors who handled the lines of one or more large companies, professors in the chemical departments of the universities who had intimate knowledge of chemical business people, and even some of those in the major construction companies that had put up plants for various of the chemical producers all proved extremely worthwhile sources of background information. By combining these inputs with analyses of the usual financial data, it only took about 3 months to narrow the choices down to one of 3 companies. From there on, the going was slower and the decisions more difficult. However, by the spring of 1947 I decided that the Dow Chemical Company would be my choice. E pluribus unum. There were many reasons for the choice of Dow Chemical from the many promising chemical firms. I believe it might be worthwhile to enumerate some of them because they are clear examples of the type of things I seek in the relatively small number of companies in which I desire to place funds. As I began to know various people in the Dow organization, I found that the growth that had already occurred was in turn creating a very real sense of excitement at many levels of management. The belief that even greater growth lay ahead permeated the organization. One of my favorite questions in talking to any top business executive for the first time is what he considers to be the most important long-range problem facing his company. When I asked this of the president of Dow, I was tremendously impressed with his answer. It is to resist the strong pressures to become a more military-like organization as we grow very much larger, and to maintain the informal relationship whereby people at quite different levels and in various departments continue to communicate with each other in a completely unstructured way and, at the same time, not create administrative chaos. I found myself in complete agreement with certain other basic company policies. Dow limited its involvement to those chemical product lines where it either was or had a reasonable chance of becoming the most efficient producer in the field as a result of greater volume, better chemical engineering and deeper understanding of the product or for some other reason. Dow was deeply aware of the need for creative research not just to be in front, but also to stay in front. There was also a strong appreciation of the people factor at Dow. There was in particular a sense of need to identify people of unusual ability early, to indoctrinate them into policies and procedures unique to Dow, and to make real efforts to see if seemingly bright people were not doing well at one job, they be given a reasonable chance to try something else that might be more suitable to their characteristics. I found that although Dow's founder, Dr. Herbert Dow, had died some 17 years before, His beliefs were held in such respect that one or another of his sayings was frequently quoted to me. While his comments were directed primarily at matters within Dow, I decided that at least two of them were equally appropriate to my own business, in that they could be applied at least as well as to optimizing the selection of investments as to matters internal to the Dow Chemical Company. One of these was never promote someone who hasn't made some bad mistakes, because if you do, you are promoting someone who has never done anything. The failure to understand this element by so many in the investment community has time and again created unusual investment opportunities in the stock market. The truly worthwhile accomplishment in the business world nearly always requires a considerable degree of pioneering, in which ingenuity has to be seasoned with practicality. This is particularly true when the gains are sought through leading-edge technological research. No matter how able the people are and no matter how good may be most of their ideas, there are times when such efforts are bound to fail, and fail dismally. When this happens and the current year's earnings drop sharply below previous estimates as the costs of the failure are added up, time and again the investment community's immediate consensus is to downgrade the quality of the management. As a result, the immediate year's lower earnings produce a lower than the historic price-earnings ratio to magnify the effect of reduced earnings. The shares often reach truly bargain prices. Yet if this is the same management that in other years has been so successful, the chances are the same ratio of average success to average failure will continue on in the future. For this reason, the shares of companies run by abnormally capable people can be tremendous bargains at the time one particular bad mistake comes to light. In contrast, the company that doesn't pioneer, doesn't take chances, and merely goes along with the crowd is liable to prove a rather mediocre investment in this highly competitive age. The other of Dr. Dow's comments which I have tried to apply to the process of investment selection is if you can't do a thing better than others are doing it, don't do it at all. In this day of heavy-handed government intervention in so many types of business activities, of high taxes and labor unions, and of rapid shifts in public taste from one product to another, it seems to me that the risk of common stock ownership is seldom warranted unless it is confined to companies with enough competitive spirit constantly to be trying and frequently succeeding in doing things in a manner superior to industry in general. In no other way are profit margins usually broad enough to meet the demands of growth. This is, of course, particularly true during periods when inflation is having a significant effect in eating away at reported profits. History versus opportunity. There were some remarkable parallels between the period when I was starting my business at the depths of the Great Depression and during the years 1947 through the very early 1950s, when I was restarting it after a military service interlude of 3.5 years. Both periods were times when it was unusually hard to obtain immediate results for clients in the face of overwhelming general pessimism. Both were times that were to prove spectacularly rewarding for those who had the patience. In the earlier period, stocks were driven to perhaps the lowest level in relation to real value seen in the 20th century, not just because of the economic havoc wrought by the Great Depression, but also because prices were discounting the worry of many investors as to whether the American system of private enterprise would itself survive. It survived, and in the ensuing years the rewards of those able and willing to invest in the right stocks were fabulous. Just a few years after World War II, another fear kept stocks at levels almost as low in relation to intrinsic value as those seen at the depths of the Great Depression. This time, business was good and corporate earnings were steadily rising. Nevertheless, almost the entire investment community were mesmerized by a simple comparison. A relatively few years after the Civil War, A period of immediate prosperity was followed by the Panic of 1873, and almost 6 years of deep depression. A somewhat similar period of prosperity after World War I was followed by the crash of 1929 and the even deeper depression of about the same length in World War II. The costs of war had run on a per diem basis about 10 times that of World War I. Therefore, reason the dominant investment view of this period, current excellent earnings don't mean anything. They will be followed by a horrendous crash and a period of extreme adversity when all would suffer. Year after year went by, and the per share earnings of more corporations rose. Along about 1949, this period became known as the era in which American business is worth more dead than alive. Because as soon as word spread that a publicly owned company was about to go out of business, its shares would rise dramatically. The liquidating value of many a company was so much more than its current market valuation. Year followed year, and slowly it began dawning on the investment public that perhaps stocks were being held back because of a myth. The expected business decline never did arrive and, excepting for 2 relatively minor recessions in the 1950s, the stage was being set for the great rewards to long-term investors that were to follow. As I write these words in the closing weeks before the decade of the 80s is about to start, it amazes me that more attention has not been paid to restudying the few years of stock market history that started in the second half of 1946 to see whether true parallels may actually exist between that period and the present. Now, for the third time in my lifetime, many stocks are again at prices which, by historic standards, are spectacularly low. In relation to reported book value, they may not be quite as cheap as they were in the post-World War II period. However, if that reported book value is adjusted for replacement value in real dollars, they may perhaps be cheaper than in either of the 2 prior, bargain value periods. The question arises, are the worries that are holding back stock values in the present period, such matters as the high cost of energy or the dangers from the political left or of overextended credit, with the inevitable resulting drain on the level of business activity as liquidity is restored, more serious and more apt to stop the future growth in this country than the fears that held back stock prices in these 2 prior periods? If not, once the problems of overextended credit have been solved, it might be logical to assume that the 1980s and period beyond may offer the same sort of rewarding opportunities that characterized the 2 former periods of abnormally low prices. Lessons from the vintage years. From a business standpoint, the 15 years from 1954 through 1969 were a magnificent time for me, as most of the relatively few stocks I was holding advanced significantly more than did the market as a whole. Even so, I managed to make some bad mistakes. Successes came from diligent application of the approaches I have already spelled out. It is the mistakes that are more noteworthy. Each brought its own new lesson. Good fortune can breed laxness. The mistake which now embarrassed me the most, although it was not the most costly, arose from the careless application of a sound principle. In the early 1960s, I had technological investments that were proving quite pleasing in the electronic, chemical, metallurgical, and machinery industries. I did not have a comparable investment in the promising drug field, and started seeking one. Along the way, I talked to a medical specialist who was preeminent in his field. At the time, he was tremendously excited about a new drug family about to be introduced by a small Midwestern manufacturer. These drugs he felt could have quite favorable impact on the future earnings of this firm relative to others in this field. The potential market seemed very, very exciting. I then talked to just one of the officers of this company and to only a few other investment people, all of whom were equally excited about the potentials of this new drug. Unfortunately, I did not pursue my standard checks either with other drug companies or with other experts knowledgeable in this particular specialty to see if they might have contrary evidence to offer. Regretfully, I subsequently learned none of the proponents had made a thorough investigation either. The stock was selling at a price well above its worth before considering the benefits of this new family of drugs, but at a price which could have been but a minor fraction of potential value if the new drugs were all their supporters imagined. I bought the shares only to see them drop, at first a mere 20% and then over 50%. Ultimately, the whole company was sold for cash at this low price to a large non-pharmaceutical corporation seeking to enter the drug field. Even at this price, now somewhat less than half of what I had paid for the shares, I subsequently learned that the acquiring company lost money on the deal. Not only did this new family of drugs fail to measure up to the extensive hopes that had been enthusiastically projected by my friend, the medical specialist, but also on painful post-mortem re-examination of the situation, I found that there were management problems in this small drug manufacturer. With a more thorough investigation, both feelings would, I believe, have become apparent to me. From that embarrassing time forward, I have tried to be particularly thorough in making investigations in periods when things were going well. The only reason this particular investment folly wasn't more costly stemmed from my caution. Since I had had only a slight contact with the management, I made only a small initial investment, planning to buy more as I got to know the company better. Their troubles overtook me before I had a chance to compound my original folly. As the long bull market was reaching its final peak in 1969, another mistake occurred. To understand what happened, it is necessary to recreate the psychological fever which gripped most investors in technological and scientific stocks at that time. Shares of these companies, particularly many of the smaller ones, had enjoyed advances far greater than the market as a whole. During 1968 and 1969, only one's imagination seemed to cap the dreams of imminent success for many of these companies. Some of these situations did have genuine potential, of course. Discrimination was at a low ebb. For example, any company serving the computer industry in any way promised a future, many believed, that was almost limitless. This contagion spread into instrument and other scientific companies as well. Up to this time, I resisted the temptation to go into any of the similar companies that had just gone public at very high prices in the previous year or two. Yet, being in frequent contact with those who were sponsoring these excitement-inducing companies, I kept looking for a few that might be genuinely attractive. In 1969, I did find an equipment company working in an extremely interesting new frontier of technology. One that had a real basis for its existence. The firm was run by a brilliant and honest president. I can remember still, after a long luncheon session with this man, my pacing up and down the airport awaiting my airplane home and trying to determine whether I should buy this company's shares at the prevailing market. After considerable deliberation, I decided to go ahead. I was right in diagnosing the potential of this company, for it did grow in the years that followed. Nevertheless, it was a poor investment. My mistake lay in the price I paid to participate in the promise. Some years later, after the company had shown rather respectable growth, I sold these shares, but at a price very little different from my original cost. Well, I believe I was right in selling when I thought the company had reached a point where its future growth was considerably more uncertain, Nevertheless, selling an investment at a meager profit after it has been held for a number of years is not the way to make capital grow or even protect it against inflation. In this case, disappointing performance was the result of being seduced by the excitement of the times into paying an unrealistic initiation price. Do few things well. A policy judgment that was wrong for me engendered quite a different kind of mistake, and one which did cost a significant amount of dollars. My mistake was to project my skill beyond the limits of experience. I began investing outside the industries which I believe I thoroughly understood, in completely different spheres of activity. Situations where I did not have comparable background knowledge. When it comes to manufacturing companies that serve industrial markets or to companies on the leading edge of technology that are serving manufacturers, I believe that I know what to look for, where both the strong points and pitfalls may lie. However, different skills proved important in evaluating companies making and selling consumer-type products. When the products of competitive companies are essentially rather similar to one another, and when changes in market share depend largely on shifting public tastes or on fashions greatly influenced by the effectiveness of advertising, I learned that the abilities which I had in selecting outstanding technological companies did not extrapolate to the point where I could identify what produces unusual success in real estate operations. Others may do well in quite diverse investment arenas. Perhaps, unlike the other types of mistakes I have made during my business career, this one should properly be ignored by others. Nevertheless, an analyst must learn the limits of his or her competence and tend well the sheep at hand. Stay or sell in anticipation of possible market downturns? Should an investor sell a good stock in the face of a potentially bad market? On this subject, I fear I hold a minority view given the investment psychology prevalent today. Now more than ever, the actions of those who control the vast bulk of equity investments in this country appear to reflect the belief that when an investor has achieved a good profit in a stock and fears the stock might well go down, he should grab his profit and get out. My view is rather different. Even if the stock of a particular company seems at or near a temporary peak and that a sizable decline may strike in the near future, I will not sell the firm's shares provided I believe that its longer-term future is sufficiently attractive. When I estimate that the price of these shares will rise to a peak quite considerably higher than the current levels in a few years' time, I prefer to hold. My belief stems from some rather fundamental considerations about the nature of the investment process. Companies with truly unusual prospects for appreciation are quite hard to find, for there are not too many of them. However, for someone who understands and applies sound fundamentals, I believe that a truly outstanding company can be differentiated from a run-of-the-mill company with perhaps 90% precision. It is vastly more difficult to forecast what a particular stock is going to do in the next 6 months. Estimates of short-term performance start with economic estimates of the coming level of general business. Yet the forecasting record of seers predicting changes in the business cycle has generally been abysmal. They can seriously misjudge if and when recessions may occur, and are worse in predicting their severity and duration. Furthermore, neither the stock market as a whole nor the course of any particular stock tends to move in close parallel with the business climate. Changes in mass psychology and in how the financial community as a whole decided to appraise the outlook either for business in general or for a particular stock can have overriding importance and can vary almost unpredictably. For these reasons, I believe that it is hard to be correct in forecasting the short-term movement of stocks more than 60% of the time, no matter how diligently this skill is cultivated. This may well be too optimistic an estimate. On the face of it, It doesn't make good sense to step out of a position where you have a 90% probability of being right because of an influence about which you might at best have a 60% chance of being right. Moreover, for those seeking major gains through long-term investments, the odds of winning are not the only consideration. If the investment is in a well-run company with sufficient financial strength, even the greatest bear market will not erase the value of holding. In contrast, time after time, truly unusual stocks have subsequent peaks many hundreds of % above their previous peaks. Thus, risk-reward considerations favor long-term investment. So, putting it in the simplest mathematical terms, both the odds and the risk-reward considerations favor holding. There is a much greater chance of being wrong in estimating adverse short-term changes for a good stock than in projecting its strong, long-term price appreciation potential. If you stay with the right stocks through even a major temporary market drop, you are at most going to be temporarily behind 40% of the former peak at the very worst point and will ultimately be ahead. Whereas if you sell and don't buy back, you will have missed long-term profits many times the short-term gains from having sold the stock in anticipation at a short-term reversal. It has been my observation that it is so difficult to time correctly the near-term price movements of an attractive stock that the profits made in the few instances when the stock is sold and subsequently replaced at significantly lower prices are dwarfed by the profits lost when timing is wrong. Many have sold too soon and have either never gotten back in or have postponed reinvestment too long to recapture the profits possible. The example I will use to illustrate this point is the weakest one I have experienced. In 1962, two of the major electronics investments I had made had risen to heights that made the outlook for near-term price movement extremely dangerous. Texas Instruments was selling at over 15 times the price I had paid for it 7 years before. Another company which I bought a year or so later, and which I shall call by the fictitious name of Central California Electronics, had enjoyed a similar percentage rise. Prices had gone too far. I consequently informed each of my clients that the prices of these two stocks were unrealistically high and discouraged them from using these prices in measuring their current net worth. This is a practice I have rarely followed, and then only when I had an unusually strong conviction that the next important move for one or more of my stocks would be sharply downward. Nevertheless, in the face of this conviction, I urged my clients to maintain their holdings, in the belief that some years ahead both stocks would rise to very much higher levels. When the correction in values came for these two stocks, it proved even more severe than I had anticipated. Texas Instruments at its subsequent bottom sold off 80% from its 1962 peak. Central California Electronics did not perform quite so badly, but still sold off by almost 60%. My beliefs were being tested in the extreme. However, within a few years Texas Instruments was once again selling at new high levels more than double its 1962 high. Patience had paid off here. Central California Electronics' performance was not a happy one. As the general stock market started to recover, problems within the management of Central California Electronics became apparent. Changes in personnel occurred. I became quite worried and made what I believe was a thorough investigation. I reached two conclusions and neither one pleased me. One was that I had misjudged the former management. I should have been more aware of its deficiencies, yet wasn't. Neither could I be sufficiently enthusiastic about the new management to warrant continuing to hold the shares. I consequently sold these holdings in the following 12-month period at a price only slightly better than half of the 1962 peak. Even so, my clients, depending on the applicable purchase price, gain from 7 to 10 times the original cost. As I have already indicated, I am deliberately citing a weak example rather than a dramatic one to illustrate why I believe it pays to ignore near-term fluctuations in situations that hold real promise. My error in the Central California Electronics instance was not in holding the shares through a temporary decline, but in something far more important. I had grown too complacent as a result of the enormous excess of my investments in this company. I began paying too much attention to what I was hearing from top management and not doing sufficient checking with people at lower levels and with customers. When I recognized the situation and acted upon it, I was then able to make the same kind of gains I had expected to make in Central California Electronics by switching these funds to other electronic companies, chiefly Motorola, which fortunately rose in the next few years to a value several times higher than the prior peak of Central California Electronics. In and out may be out of the money. There is more to learn from the Texas Instruments and Central California Electronics situations. When I originally acquired these Texas Instruments shares in the summer of 1955, they were bought for the longest type of long-range investment. It seemed to me the company fully warranted this degree of confidence. About a year later, the stocks had doubled. With one exception, the various owners of the fund I managed, familiar as they were with my method of operations, showed no more interest in taking a profit than did I. However, at that time I had one relatively new account owned by people who, in their own business, were used to building up inventory when markets were low and cutting it back sharply when they were high. Now that Texas Instruments had doubled, they brought strong pressure to sell, which for a time I was able to resist. When the stock rose an additional 25% to give them a profit of 125% of their cost, the pressure to sell became even stronger. They explained, "We agree with you. We like the company, but we can always buy it back at a better price on a decline." I finally compromised with them by persuading them to keep part of their holding and sell the rest. Yet when the big drop occurred several years later and the shares fell 80% from their peak, this new bottom was still almost 40% higher than the price at which this particular holder was so eager to sell. After a very sharp advance, a stock nearly always looks too high to the financially untrained. This client demonstrated another risk to those who follow the practice of selling shares that still have unusual growth prospects simply because they have realized a good gain and the stock appears temporarily overpriced. These investors seldom buy back at higher prices when they are wrong and lose further gains of dramatic proportions. At the risk of being repetitious, let me underscore my belief that the short-term price movements are so inherently tricky to predict that I do not believe it possible to play the in and out game and still make the enormous profits that have accrued again and again to the truly long-term holder of the right stocks. The long shadow of dividends. In these comments I have tried to show how, as the years have passed, various experiences gradually helped to shape my investment philosophy. However, looking back, I find no specific event either a mistake or a favorable opportunity, which caused me to reach the conclusions I have on the matter of dividends. Many observations over a long period of years gradually crystallized my views. I started out taking for granted the belief, as widely accepted 40 years ago as it is today, that dividends were something highly favorable to the stockholder and something which should be welcomed enthusiastically. Then I began seeing companies that had so many exciting-looking new ideas flowing from their research departments that they could not capitalize upon them all. Resources were too scarce or too expensive. I began thinking how much better it might be for some stockholders if, instead of paying dividends, more of the company's resources were retained and invested in more of these innovative products. I began increasingly to recognize that the interests of all stockholders were not identical. Some investors needed dividend income to support their lifestyle. These stockholders would undoubtedly prefer current dividends to greater future profits and increased value for their shares resulting from increased investment in promising products and technologies. These investors could fund investments in firms whose needs and opportunities for productive use of capital were not too demanding. But how about the stockholder whose earning power or other income sources exceeded needs and who was regularly saving money anyway? Would it not be better for this investor if the company passed up its dividends, which would often be subject to a fairly high income tax rate, and instead reinvested the funds, tax-free, in future growth? Shortly after World War II, when I started concentrating my investment activities almost solely on the attainment of major, long-range capital appreciation, another aspect of the dividend payout issue became even more apparent. The companies with the greatest growth prospects were under tremendous pressure to pay no dividends at all. Their need for funds and their ability to use funds productively was too large. The cost of developing these new products was just the first heavy drain on capital needed to finance growth. There followed the heavy marketing expense needed to introduce them to the customer. With success, planned expansion was needed to service a growing volume. Once the new line was on its way, there were further capital requirements for the increased inventories and accounts receivable which, in most cases, grow almost in direct proportion to the volume of the business. There seemed a natural fit of interest between those firms with bountiful investment opportunities and certain investors who sought to make the greatest possible profit in relation to the risk involved and who neither needed additional income nor wanted to pay unnecessary taxes. Such investors should, I believe, mainly confine investments to non-dividend paying companies with strong earning power and with attractive places to reinvest their earnings. These were the clients I sought to serve. Recently, however, the situation has become less clear-cut. Institutional holders have become an increasingly dominant force in day-to-day stock transactions. Institutions such as pension and profit-sharing funds pay no income tax on their dividends. Many of them, as a matter of policy, will not invest in a company unless it pays some dividend, no matter how small. Attracting and holding these buyers have caused many companies with unusual prospects to initiate modest dividend payments of rather small percentage total annual earnings. Managers of some would-be growth companies have concurrently reduced their payout dramatically. Today, the skill in investing retained earnings wisely has become a more critical factor in separating the unusual company from the pack. For these reasons, I have come to believe that the most that can be said on the subject of dividends is that it is an influence that should be downgraded very sharply by those who do not need the income. In general, more attractive opportunities will be found among stocks with a low dividend payout or none at all. However, so general is the feeling among those who determine dividend policies that paying out dividends is beneficial to the investor, as it is for some, that occasionally I have found truly attractive opportunities among higher dividend payout companies, although this has not happened very often. 4. Is the market efficient? By the coming of the 1970s, nearly all of my investment philosophy was firmly in place, molded by my experience of 4 prior decades. It is not coincidence that with only one exception all of both the wise and the foolish actions I have mentioned as examples that helped form the background of this philosophy were incidents that occurred during these 4 prior decades. This does not mean that I have made no mistakes in the 1970s. Unfortunately, It seems that no matter how much I try, sometimes I must stub my toe more than once in the same way before I truly learn. However, in the examples I have used, I usually took the first instance when a particular type of event happens to illustrate my point, which explains why all but one of the examples I used occurred during these earlier periods. It might be helpful to notice the striking parallels in each of these past 10-year periods. With the possible exception of the 1960s, there has not been a single decade in which there was not some period of time when the prevailing view was that external influences were so great and so much beyond the control of individual corporate managements that even the wisest common stock investments were foolhardy and perhaps not for the prudent. In the 1930s there were years when this view, influenced by the Great Depression, was at its most extreme, but perhaps not any more than the fear of what the German war machine and World War II might do in the 1940s, or the certainty that another major depression would hit in the 1950s, or fear of inflation, hostile government actions, etc., in the 1970s. Yet every one of these periods created investment opportunities that seemed almost incredible. With all the advantages of hindsight. In each of these 5 decades there were not a few, but many common stock opportunities that 10 years later yielded profits running to many hundreds of % for those who had bought and stayed with the shares. In some instances profits ran well into the thousands of %. Again, in every one of these 5 decades some stocks which were the speculative darlings of the moment were to prove the most dangerous kind of trap for those who blindly followed the crowd rather than those who really knew what they were doing. All of these 10-year periods essentially resembled the others in that the greatest opportunities came from finding situations that were extremely attractive but that were undervalued because at that particular moment the financial community had significantly misjudged the situation. As I look back on the various forces that buffeted the securities market over this 50-year period and at the great waves of public optimism and pessimism that succeeded each other over this time span, the old French proverb, plus qu'à change, plus c'est la même chose, the more things change, the more they remain the same, comes to mind. I have not the slightest doubt that as we enter the emerging decade of the 1980s, with all the problems and the prospects that it now offers, this same will continue to hold true. The fallacy of the efficient market. In the last few years too much attention has been paid to a concept that I believe is quite fallacious. I refer to the notion that the market is perfectly efficient. Like other false beliefs in other periods, a contrary view may open up opportunities for the discerning. For those unfamiliar with efficient market theory, the adjective efficient does not refer to the obvious mechanical efficiency of the market. A potential buyer or seller can get his order to the market where a transaction can be executed very effectively within a matter of a couple of minutes. Neither does efficiency refer to the delicate adjustment mechanism which causes stock prices to move up or down by fractions of a point in response to modest changes in the relative pressure of buyers and sellers. Rather, this concept holds that at any one time the market-efficient prices are assumed to reflect fully and realistically all that is known about the company. Unless someone has some significant, illicit inside information, there is no way genuine bargains can be found. Since the favorable influences that make a potential buyer believe that an attractive situation exists are already reflected in the price of stock. If the market was as efficient as it has become fashionable to believe, and if important opportunities to buy or significant reasons to sell were not constantly occurring, stock returns should not subsequently have the huge variations that they do. By variation, I am not referring to changes in prices for the market as a whole, but rather the dispersion of relative price changes of one stock against another. If the market is efficient in prospect, then the nexus of analysis that leads to this efficiency must be collectively poor. Efficient market theory grew out of the academic school of random walkers. These people found that it was difficult to identify technical trading strategies that worked well enough after transactions costs to provide an attractive profit relative to the risks taken. I don't disagree with this. As you have seen, I believe that it is very, very tough to make money with in-and-out trading based on short-term market forecasts. Perhaps the market is efficient in this narrow sense of the word. Most of us are or should be investors, not traders. We should be seeking investment opportunities with unusual prospects over the long run and avoiding investment opportunities with poorer prospects. This has always been the central tenet of my approach to investments in any case. I do not believe that prices are efficient for the diligent, knowledgeable, long-term investor. Directly applicable to this is an experience I had in 1961. In the fall of that year, as in the spring of 1963, I undertook the stimulating duty of substituting for the regular finance professor in teaching the senior course of investments at Stanford University's Graduate School of Business. The concept of the efficient market was not to see the light of day for many years to come and had nothing to do with my motivation in the exercise I am about to describe. Rather, I wanted to show these students in a way they would never forget that the fluctuations of the market as a whole were insignificant compared to the differences between the changes in price of some stocks in relation to others. I divided the class into two groups. The first group took the alphabetical list of stocks on the New York Stock Exchange, starting with the letter A. The second group, those starting with the letter T. Every stock was included in alphabetical order, except preferreds and utilities, which I considered to be a different breed of cats. Each student was assigned 4 stocks. Each student looked at the closing price as of the last day of business of 1956, adjusted the stock dividends and stock splits. Rights were ignored as not having sufficient impact to be worthy of the additional calculations, and compared this price with the price as of Friday, October 13th, if nothing else, a colorful closing date. The percentage increase or decrease that occurred in each stock over this period of almost 5 years was noted. The Dow Jones averages rose from 499 to 703, or by 41% in this period. Altogether, there were 140 stocks in this sample. The results are displayed in the following table. These data are quite insightful. In a period when the Dow Jones averages rose 41%, 38 stocks, or 27% of the total, showed a capital loss. 6 of them, or 4% of the total, recorded a loss of over 50% of their total value. In contrast, roughly 1/4 of the stocks realized capital gains that would have been considered spectacular. To drive the point home, I noted that if a person invested $10,000 in equal amounts in the 5 best stocks on this list, at the outset of this 4.75-year period, his capital would now be worth $70,260. On the other hand, if he had invested the $10,000 in the 5 worst stocks, his capital would have shrunk to $3,180. These extreme results were most unlikely. It would take luck, either good or bad, as well as skill, to hit either of these extremes. It would not be so implausible for a person with real investment judgment to have picked 5 out of the 10 best stocks for his $10,000 investment, in which case his net worth on Friday the 13th would have been $52,070. Similarly, some investors consistently select stocks for the wrong reasons and manage to pick lemons. For them, selecting 5 out of the 10 poorest in performance is also not an entirely unrealistic expectation of results. In that case, the $10,000 investment would have shrunk to $4,270. On the basis of this comparison, there might be, in less than 5 years, a difference of $48,000 between a wise and an unwise investment program. A year and a half later, when I also taught the same course, I repeated the exact same exercise, with the exception that instead of using the letters A and T, I selected 2 different letters in the alphabet from which to form the sample of stocks. Again, over a 5-year time frame, but with a different starting and a different closing date, the degree of variation was almost exactly the same. Looking back on most markets of 5-year duration, I believe that one can find stock performance results that are about as disparate. Some of this dispersion may come as a result of surprises, important new information about a stock's prospects that could not be reasonably foreseen at the outset of the period. Most of the differences, however, can be anticipated at least roughly both in terms of direction and general magnitude of gains and losses relative to the market. The Raychem Corporation. In view of this kind of evidence, it is hard for me to see how anyone can consider the stock market efficient, again using the word efficient as it is used by the proponents of this theory. But to belabor the point further, let me take a stock market situation of just a very few years ago. In the early years of the 1970s, the shares of the Raychem Corporation had considerable prestige in the marketplace and were accordingly selling at a relatively high price-earnings ratio. Some of the reasons warranting this prestige may be perceived by some comments made by the company's executive vice president, Robert M. Halpern. In outlining what he called the 4 cardinal points to Raychem's operating philosophy, he stated, 1. Raychem will not do anything technically simple, i.e., something that would be easy for potential competitors to copy. 2. Raychem won't do anything unless it can be vertically integrated. That is, Raychem must conceive the product, manufacture it, and sell it to the customer. 3. Raychem won't do anything unless there is a substantial opportunity for real proprietary protection, which generally means patent protection. Unless this occurs, research and development energies will not be employed on a project, even though otherwise it might fit into Raychem's skills. 4. Raychem will only go into new products when it believes it can become the market leader in whatever niche, sometimes smaller, sometimes larger, that product attempts to capture. By the mid-1970s, awareness of these unusual strengths was sufficiently prevalent among those who controlled large institutional funds so that sizable blocks of shares had been taken out of the market by people who believed that Raychem was a situation of unusual competitive strength and attractiveness. However, it was another aspect of this company that gave Raychem its greatest appeal to these holders and was probably the cause of the high price-earnings ratio at which it was then selling. Many considered that Raychem, which was spending an above-average percentage of sales on new project development, had perfected a research organization capable of producing an important enough stream of new products so that the company could be depended on to show an uninterrupted upward trend in sales and profits. These research products had quite justifiably a special appeal to the financial community because many of the newer ones only indirectly competed with older products of other companies. Primarily, the new products enabled high-priced labor to do the same job in considerably less time than had previously been required. There were enough savings offered to the ultimate customer of these products to justify a price which should afford Raychem a pleasing profit margin. All this caused the stock toward the end of 1975 to reach a high of over $42.50, price adjusted for subsequent stock splits, a level about 25 times the estimated earnings for the fiscal year ending June 30, 1976. Raychem dashed expectations, and the crash, toward the close of the June 30, 1976, fiscal year, Raychem was hit by two hammer blows, which were to play havoc with the price of the stock and with the company's reputation in the financial community. The financial community had become very excited about a proprietary polymer, styrene, which enjoyed unique advantages over other compounds used by the airplane industry for coating wire and which was then in the final research stages. Furthermore, the polymer was to be the first product in which Raychem would go basic, that is, make the original chemicals in its own plant rather than buying raw materials from others and compounding them. Because of the appeal of the product, Raychem had allocated by a considerable margin more funds to this research product than to any other in its history. The financial community assumed this product was already on its way to success, and after passing through the usual learning curve experienced by all new products, it would become highly profitable. Actually, quite the opposite was occurring. In the words of the Raychem management, styrene was a scientific success but a commercial failure. Improved products of an able competitor, while technically not as desirable as styrene, proved adequate for the job and were far cheaper. Raychem management recognized this. In the course of a relatively few weeks, management reached the painful decision to abandon the product and write off the heavy investments made in it. The resulting charge to earnings for that fiscal year was some $9.3 million. This charge-off caused earnings, exclusive of some offsetting special gains, to drop to 8 cents a share from $7.95 the previous fiscal year. The financial community was as much upset by the erosion of the great confidence in the company's research ability as by the precipitous drop in earnings. Largely ignored was the basic rule that some new product developments are bound to fail in all companies. This is inherent in all industrial research activity and in a well-run company is far more than offset in the long run by other successful new products. It may have been just bad luck that the particular project on which the most money had been spent had been the one to fail. At any rate, the effect on the stock price was dramatic. By the fourth quarter of 1976, the stocks had dropped to a low of approximately $14.75, again adjusted for subsequent splits amounting to 6-1, or to approximately on its former high. Of course, only a tiny amount of stock could be bought or sold at the low point for the year. Of greater impact, the stock was available at prices only moderately above this low level for months thereafter. Another development also affected the profits of the company at this moment and contributed to Raychem's fall from favor. One of the most difficult tasks for those responsible for the success of any growing company is to change the management structure appropriately as the company grows to allow for the difference between what is needed for proper control of small companies and optimum control of big companies. Until the end of the 1976 fiscal year, Raychem management had been set up along divisional lines based largely on manufacturing techniques. That is, on the basis of the products produced. This worked well when the company was smaller, but was not conducive to serving the customer most efficiently as the company was growing. Therefore, at about the end of the 1975 fiscal year, top Raychem management started working on a big company management concept. The firm restructured the divisions by the industry served rather than by the physical and chemical composition of the products being manufactured. The target date to make the change was set at the end of the 1976 fiscal year. This was done at a time when there was not the least thought within the management that this date would coincide with the time of the huge write-off for the abandonment of styrene. Everyone in Raychem knew that when the organizational change was to occur there would be at least one quarter and probably a minimum of two of substantially reduced earnings. While making these changes caused almost no change in the individuals on the Raychem management payroll, so many people now had different superiors, different subordinates, and different co-workers with whom they had to interface their activities that a time of inefficiency and adjustment was bound to occur until Raychem employees learn how best to coordinate their work with the new faces with whom they were now dealing. Perhaps no stronger indication could have existed to justify long-range confidence in this company or to indicate that management was not concerned with short-term results than its decision to go ahead with this project as planned rather than to postpone what was bound to be a second blow to Raychem's current earnings. Actually, this significant change worked with considerably less difficulty than had been anticipated. As expected, the first quarter earnings of the new fiscal year were much lower than would have been the case if the change had not been made. However, the change was working so well that as the second quarter progressed, the short-term costs of what had been done had largely been eliminated. Fundamentally, these developments should have been considered bullish by analysts. Raychem was now in a position to handle growth properly in a way that could not have been done before. It had successfully hurdled a barrier of the type that is most apt to dull the luster of otherwise attractive growth companies. By and large, the financial community did not seem to recognize this, however, and instead the temporary further shrinkage of earnings was just one more factor holding the stock at the low levels to which it had fallen. Making these price levels even more attractive to potential investors was another influence that I have seen happen in other companies shortly after they had abandoned a major research project that had proved unsuccessful. One financial effect of the abandonment of Stalin was that a sizable amount of money that had heretofore been devoted to that project was now free to be allocated elsewhere. Even more important, it had similarly freed the time of key research people for other endeavors. Within a year or two, much like a field of flowers starting to bloom when rain follows drought, the company began to enjoy what was possibly a greater number of attractive research projects in relation to its size than had ever before been experienced. Raychem and the efficient market. Now, what has Raychem's situation to do with this theory of an efficient market that has recently gained such a following in certain financial quarters? According to that theory, stocks automatically and instantly adjust to whatever is known about a company, so that only those who might possess illicit inside information that is not known to others could benefit from what might lie ahead for a particular stock. In this instance, at the drop of a hat, the Raychem management would indeed explain to anyone interested all the facts I have just cited and explained how temporary they believed was a period of poor earnings. Actually, well, after all this had happened and when profits were climbing to a new all-time high level, the Raychem management went even further. On January 26, 1978, they held a long one-day meeting at their headquarters which I had the privilege of attending. Raychem management invited to this meeting the representatives of all institutions, brokerage houses, and investment advisors who either had any interest in Raychem or they thought might have. At this meeting, the 10 most senior executives of Raychem explained with what I believe was extreme frankness and in detail, such as I have only occasionally seen at similar meetings of other companies, the prospects, the problems, and the current status of Raychem matters under their jurisdiction. In the year or two following this meeting, Raychem's earnings growth developed exactly as might have been inferred from what was said there. During that period, the stock was to much more than double from the price of $23 one quarter at which it was selling that day. Yet in the weeks immediately following this meeting, there was no particular effect on the stock whatsoever. Some of those present were obviously impressed by the picture being presented. Too many, however, were still under the influence of the double shock that they had experienced a year or two before. They obviously mistrusted what was being told them then. So much for the theory of an efficient market. What kind of conclusion does the investor or the investment professional reach from experiences like Reiki? By and large, those who have accepted and been influenced by this theory of the efficient market fall into two groups. One is students, who have had a minimum of practical experience. The other, strangely enough, seems to be many managers of large institutional funds. The individual private investor, by and large, has paid relatively little attention to this theory. From this experience gained in applying my personal investment philosophy, I would conclude that in my field of technological stocks, as the decade of the 1970s comes to an end, there would therefore be more attractive opportunities among the larger companies, the market for which is dominated by the institutions, than among the small technological companies where the individual private investor plays a considerably bigger role. Just as some 10 years earlier those who recognized the folly of the then prevailing concept of the two-tier market benefited from recognizing that particular nonsense for what it was, so in each decade false ideas arise, creating opportunities for those with investment discernment. Conclusion: this then is my investment philosophy as it has emerged over a half-century of business experience. Perhaps the heart of it may be summarized in the following 8 points. 1. Buy into companies that have disciplined plans for achieving dramatic long-range growth in profits and that have inherent qualities making it difficult for newcomers to share in that growth. There are so many details, both favorable and unfavorable, that should also be considered in selecting one of these companies that it is obviously impossible in a monograph of this length to cover them adequately. For those interested, I have attempted to summarize the subject as concisely as I could in the first 3 chapters of Conservative Investors Sleep Well. A brief outline appears in the appendix. To focus on buying these companies when they are out of favor. That is, when either because of general market conditions or because the financial community at the moment has misconceptions of its true worth, the stock is selling at prices well under what it will be when its true merit is better understood. 3. Hold the stock until either A. there has been a fundamental change in its nature, such as a weakening of management through changed personnel, or B. it has grown to a point where it no longer will be growing faster than the economy as a whole. Only in the most exceptional circumstances, if ever, sell because of forecasts as to what the economy or the stock market is going to do, because these changes are too difficult to predict. Never sell the most attractive stocks you own for short-term reasons. However, as companies grow, remember that many companies that are quite efficiently run when they are small fail to change management style to meet the different requirements of skill big companies need. When management fails to grow as companies grow, shares should be sold. 4. For those primarily seeking major appreciation of their capital, de-emphasize the importance of dividends. The most attractive opportunities are most likely to occur in the profitable, but low or no dividend payout groups. Unusual opportunities are much less likely to be found in situations where a high percentage of profits is paid to stockholders. 5. Making some mistakes is as much an inherent cost of investing for major gains as making some bad loans is inevitable in even the best run and most profitable lending institution. The important thing is to recognize them as soon as possible, to understand their causes, and to learn how to keep from repeating the mistakes. Conservative Investors Sleep Well, Harper and Row, 1975. Willingness to take small losses in some stocks and to let profits grow bigger and bigger in the more promising stocks is a sign of good investment management. Taking small profits in good investments and letting losses grow in bad ones is a sign of abominable investment judgment. A profit should never be taken just for the satisfaction of taking it. 6. There are a relatively small number of truly outstanding companies. Their shares frequently can't be bought at attractive prices. Therefore, when favorable prices exist, full advantage should be taken of the situation. Funds should be concentrated in the most desirable opportunities. For those involved in venture capital and quite small companies, say with annual sales of under $25 million, more diversification may be necessary. For larger companies, proper diversification requires investing in a variety of industries with different economic characteristics. For individuals, in possible contrast to institutions and certain types of funds, any holding of over 20 different stocks is a sign of financial incompetence. 10 or 12 is usually a better number. Sometimes the costs of the capital gains tax may justify taking several years to complete a move toward concentration. As an individual's holdings climb toward as many as 20 stocks, it nearly always is desirable to switch from the least attractive of these stocks to more of the attractive. It should be remembered that ERSA stands for emasculated results, insufficient sophisticated action. 7. A basic ingredient of outstanding common stock management is the ability neither to accept blindly whatever may be the dominant opinion in the financial community at the moment, nor to reject the prevailing view just to be contrary for the sake of being contrary. Rather, it is to have more knowledge and to apply better judgment, in thorough evaluation of specific situations, and the moral courage to act in opposition to the crowd when your judgment tells you you are right. 8. In handling common stocks, as in most other fields of human activity, success greatly depends on a combination of hard work, intelligence, and honesty. Some of us may be born with a greater or lesser degree of each of these traits than others. However, I believe all of us can grow our capabilities in each of these areas if we discipline ourselves and make the effort. While good fortune will always play some part in managing common stock portfolios, luck tends to even out. Sustained success requires skill and consistent application of sound principles. Within the framework of my 8 guidelines, I believe that the future will largely belong to those who, through self-discipline, make the effort to achieve it. Appendix: Key factors in evaluating promising firms. My philosophy calls for making a relatively small number of investments but only in unusually promising companies. Obviously, I am looking for signs of growth potential in the companies I study. As important, I am trying, through my analysis, to avoid risk. I want to make sure that the firm's management has the wherewithal to capitalize on the potential and to minimize my investment risks in the process. Summarized below are some of the defensive characteristics that I search for in the companies that are to meet my standards of unusual promise when I undertake financial analysis, interviews with management, and discussions with informed people associated with the industry. Functional factors: 1. The firm must be one of the lowest cost producers of its products or services relative to its competition, and must promise to remain so. A comparatively low break-even will enable this firm to survive depressed market conditions and to strengthen its market. Excerpts from Fisher, Conservative Investors Sleep Well, Harper and Row, 1975. Chapters 1-3. And pricing position when weaker competitors are driven out of the market. B. A higher than average profit margin enables the firm to generate more funds internally to sustain growth without as much dilution caused by equity sales or strain caused by overdependence on fixed income financing. 2. A firm must have a strong enough customer orientation to recognize changes in customer needs and interests and then to react promptly to those changes in an appropriate manner. This capability should lead to generating a flow of new products that more than offset lines maturing or becoming obsolete. 3. Effective marketing requires not only understanding of what customers want, but also explaining to them, through advertising, selling or other means, in terms the customer will understand. Close control and constant monitoring of the cost-effectiveness of market efforts are required. 4. Even non-technical firms today require a strong and well-directed research capability to a. Produce newer and better products, and b. Perform services in a more effective or efficient way. 5. There are wide differences in the effectiveness of research. 2. Important elements of more productive research are a. Market/profit consciousness, and b. The ability to pull necessary talent into an effective working team. 6. A firm with a strong financial team has several important advantages. A. Good cost information enables management to direct its energies toward those products with the highest potential for profit contribution. B. The cost system should pinpoint where production, marketing, and research costs are inefficient even in subparts of the operation. C. Capital conservation through tight control of fixed and working capital investments. 7. A critical finance function is to provide an early warning system to identify influences that could threaten the profit plan sufficiently ahead of time to devise remedial plans to minimize adverse surprises. People factors. 1. To become more successful, a firm needs a leader with a determined entrepreneurial personality combining the drive, the original ideas, and the skills necessary to build the fortunes of the firm. 2. A growth-oriented chief executive must surround himself with an extremely competent team and to delegate considerable authority to them to run the activities of the firm. Teamwork, as distinct from dysfunction struggles for power, is critical. 3. Attention must be paid to attracting competent managers at lower levels and to training them for larger responsibilities. Succession should largely be from the available talent pool. The need to recruit the chief executive from outside is a particularly dangerous sign. 4. The entrepreneurial spirit must permeate the organization. 5. More successful firms usually have some unique personality traits, some special ways of doing things that are particularly effective for their management team. This is a positive, not a negative sign. 6. Management must recognize and be attuned to the fact that the world in which they are operating is changing at an ever-increasing rate. A. Every accepted way of doing things must be re-examined periodically, and new, better ways sought. B. Changes in managerial approaches involve necessary risks, which must be recognized, minimized and taken. 7. There must be a genuine, realistic, conscious and continuous effort to have employees at every level, including the blue-collar workers, believe that their company is really a good place to work. A. Employees must be treated with reasonable dignity and decency. B. The firm's work environment and benefits programs should Be supportive of motivation. C. People must feel they can express grievances without fear and, with reasonable expectation of appropriate attention and action. D. Participatory programs seem to work well and be an important source of good ideas. 8. Management must be willing to submit to the disciplines required of sound growth. Growth requires some sacrifice of current profits to lay the foundation for worthwhile future improvement. Business characteristics. 1. Although managers rely heavily on return of assets in considering new investments, investors must recognize that historic assets, stated at historic costs, distort comparisons of firms' performance. Favorable profit-to-sales ratios, notwithstanding differences in turnover ratios, may be a better indicator of the safety of an investment, particularly in an inflationary environment. 2. High margins attract competition, and competition erodes profit opportunities. The best way to mute competition is to operate so efficiently that there is no incentive left for the potential entrant. 3. Efficiencies of scale are often counterbalanced by the inefficiencies of bureaucratic layers of middle management. In a well-run firm, however, the industry leadership position creates a strong, competitive advantage that should be attractive to investors. 4. Getting there first in a new product market is a long step toward becoming first. Some firms are better geared to be there first. 5. Products are not islands. There is an indirect competition, for example, for consumers' dollars. As prices change, some products may lose attractiveness even in well-run, low-cost companies. 6. It is hard to introduce new, superior products in market arenas where established competitors already have a strong position. While the new entrant is building the production, marketing, power, and reputation to be competitive, existing competitors can take strong defensive actions to regain the market threatened. Innovators have a better chance of success if they combine technology disciplines, for example, electronics and nucleonics, in a way that is novel relative to existing competitive competencies. 7. Technology is just one avenue to industry leadership. Developing a consumer franchise is another. Service excellence is still another. Whatever the case, a strong ability to defend established markets against new competitors is essential for sound investment. If you like our content, feel free to give us a thumbs up. Also, don't forget to share, subscribe, and press the bell icon to get notified as we upload great content on YouTube. Thank you for listening. This is Read for Free Audiobooks. Stay blessed.
Thanks for watching. Like and subscribe.